Oil prices held steady as crude benchmarks hovered around $68 for Brent and $65 for WTI, after a sharp drop earlier in the week. Initial gains were driven by President Trump reaffirming pressure on Iran by warning Tehran over its oil exports, while underscoring stricter sanctions. At the same time, U.S. government data showed shrinking oil inventories, with American crude stockpiles falling for the fifth straight week, the lowest seasonal levels in over a decade, signaling robust demand. These developments kept crude prices afloat despite geopolitical tensions, tone shifting toward cautious optimism. Trump actually remarked that a ceasefire between Israel and Iran was effectively in place, though he warned of the conflict potentially reigniting. With markets eyeing the upcoming OPEC Plus meeting scheduled for early July, traders are weighing the balance between tightening supply and geopolitical risk. Energy analysts emphasize that while the Iran-Israel crisis created a temporary risk premium, the broader market remains favorably oversupplied by around 2 million barrels per day. This suggests that without actual supply disruption, such as a Strait of Hormuz closure, any price increase is likely capped. However, reduced U.S. inventories and firm gasoline demand have propped up prices, even as the initial geopolitical spike moderated toward the week's close. In addition, signals from Washington that China may continue importing Iranian oil under a ceasefire have led to cautious sentiment. Meanwhile, talk of U.S. sanctions compliance and drilling encouragement by Trump adds another layer of complexity to the oil narrative. Looking ahead, the key drivers will be OPEC Plus production decisions, Iran's next moves, and further crude inventory data. If inventory draws continue coupled with sustained geopolitical tension, prices could trend higher. But markets remain wary, as a stabilization in supply-demand dynamics and absence of disruption will likely rein in price excursions.